Well, welcome to week 6. This week's topic is risk management. So make sure you read through your chapter. There will be a few things in the chapter that will definitely pop up between the quiz and also the discussion board for the week. You'll need to see a few things out of the chapter to answer the questions thoroughly enough. But let's talk about risk. There's lots of aspects to risk that we need to be concerned about. Let's talk about what those are. First, we'll look at risk from investments, investment returns. So this example of risk comes from having the right balance of investment. So think of a company trying to take extra cash, invest that, and seeking to get the maximum return and matching risk and return properly. Everybody should know that the more risk you take, the more return that you should demand. The less risk you take, the less return that you should demand. Returns can be expressed in dollar terms or percentage terms. We'll talk about both of those here. So we're doing that from here, saying if you invested 1,000, received 1,060, clearly you made a 6% return. So investment risk then is exposure to chances of earning less than expected. And the greater the chance of return far below the expected return, the greater the risk. So that's what investment risk is, looking at it from that perspective. So in finance, what we like to do is assign our probability to different scenarios. And so in this example, they're taking a 10-year zero coupon T-bond and saying what are the probabilities of returns for different ranges here. And there's some science behind where these probabilities come from. But just know that a lot of work and study goes into determining what those are. History, the economy. You can actually do a class based on a probability to come up with those numbers should be. We'll just go with what they're giving to us. But we're basically just saying is we've got different ranges of potential returns. And we have different probabilities assigned to those returns. You can see we're most likely expecting a 40% chance of a 6% return. But it could go above that or below that. I'm just going to graph that, just kind of see the probability here on a chart, which makes it a little bit more easier to follow. And then what they're going to do is do a distribution of those returns. So basically saying this is the same that we just got done doing, the same chart right here, just now we're graphing it as a probability. So here is the continuous probability of the distribution of returns for the 10-year T-bond. Now what you can do is do a percent of those. So what we're going to do is take all those percentages and multiply them by each other. So I'll go back a couple of slides. And we're just multiplying these by each other. 0.1 times negative 14, 0.2 times negative 4, and so on. Okay, and what that gets us to then is we would expect the probability of all those sums of returns to be 6%, which we know is the 40% one anyway. Well, that's the one we most likely expect. So we'll go with the return of 6%. And so what this is doing is graphing two different returns, the blue and the yellow, and saying what's the probability of each returning. So clearly the blue one has less risk and more certainty, because what's in blue is there's a very high possibility of getting to the 6% and less probability of getting either negative 10 or negative 20. The yellow one, though, does not have a very high return, but unfortunately it has some very negatives that are potentially could happen. Okay, so everybody kind of should see that. So standalone risk is what they call standard deviation, and that's really what this is measuring, is what is the standard deviation of the different returns. Okay, so standalone risk is the risk of each asset just being held by itself, and standard deviation measures the dispersion of the possible outcomes. And so for any single asset, standalone risk and standard deviation are the same thing. Now, if the returns are normally distributed, the outcome will be more than 1, which is the little 0 here with the line, is your standard deviation sign. And then down here, what they're saying is the outcome of 1 standard deviation away from the return is about 32% of the time. And then if R, the return is 6% and the deviation is 11%, then it's just telling us what the variation is. So really what they're just saying is we have different variations of deviation, if that makes sense. And let me go back a slide and kind of explain that again. So right here you can see here the yellow one, there's more deviation. The blue one, there's less deviation. So that's the dispersion of the returns. Okay. And the reason that's important is that we can use those to compare different investments. Investments with bigger standard deviations have more risks, and high risk doesn't mean you should reject the investment. However, it just means you need to know what the risk is before investing. And of course, we all know that the higher the risk, the higher the return. So that's part of it also. Which really leads us to a portfolio, and that's kind of why this fits into the risk topic of our chapter. And what we want to figure out next is, of course, that a portfolio should have more than one stock in it, because that means you are minimizing some risk. If you invest everything in one stock, clearly you're taking on more risk than you should. So the portfolio return needs to be weighted to what percent you own in each particular stock. So here is the example then of a two-stock portfolio. Form a portfolio by selling 25% of the Blandy stock. They're just giving us two sample companies here, Blandy or Gourmand. And what they're saying is we have 25% of one, 75% of another. And is that the right optimal mix to maximize our risk and reward with taking on that portfolio? And so what they're saying here is the two stocks do not correlate. So if one goes down, the blue one goes down, which is Gourmand. Red typically doesn't go down as much, and vice versa. If Gourmand goes up, red or Blandy stays flat, and so on. So what they've done is they've tracked it over 10 years and said, how do they correlate to each other? They don't move in perfect lockstep. There are times when they do move in the same direction. Not always, though. You can see in the first few years they didn't always move in the same direction. The last 5 years or so they have, but not at the same rate. And so the purpose of knowing that is that will reduce our risk. Okay, so basically if we've got two stocks, and it says here that a two-stock portfolio can get down to where the standard deviation comes down to 0, and therefore we are reducing our risk. Okay, so now one thing about investing in a portfolio of stocks is there will always be risk. Okay, we'll never eliminate all the risk. However, we can find an optimal portfolio to invest in. Okay, now it says here if we were to, what would happen to the risk of an average one stock portfolio as more randomly selected stocks were added? The deviation would decrease because added stock would not perfectly correlate with whatever stock is there. Okay, and so this is really what I'm trying to get to, is this slide right here saying the more stocks you have, and you can kind of see that the blue line, the portfolio risk, comes down severely starting right around 10 to 20. I've had different authors kind of mention different numbers of stocks that you should try to have in a portfolio to minimize portfolio risk. And I've seen those numbers, 10, 15, 20. Those are the ranges I typically see. And you can kind of see that's what this author is saying. But then they're saying there's a percent of risk that you will never eliminate, and that's just the market risk. That basically, no matter how many stocks you have in your portfolio, you will always bear market risk. So standalone risk is your market risk plus your diversifiable risk. So market risk cannot be eliminated by diversification. However, firm-specific or diversifiable risk can be eliminated by diversification. So what they mean, go back to here and go, if I only owned one stock and that one stock was in, you name the industry, I'm taking on risk from being exposed in that industry quite heavily plus market risk. Now as I begin to add on more stocks, so if the first stock I buy is a technology stock, there's a lot of risk there with those. let's say then I buy an airline stock, then I buy a retail stock, then I buy a power utility, and so on. So now I am minimizing my exposure to specific risks in specific industries and decreasing my total portfolio risk, but I always bear the market risk. Okay, that's what they meant by that. So then just to summarize that, the more stocks we add to a portfolio, each new stock though has a smaller risk reducing impact on the portfolio. Okay, and it says here falls very slowly after about 40 stocks, and it will never get reduced by below 20%. Now we measure risk with a term called beta, and beta is the standard deviation goes into measuring beta, and beta is the measurement of how does a particular stock value change against the market. So for example, if the market goes up 10%, did that stock go up 10%, or did it go up 12% or 8%? So it's basically what's that correlation of any one individual stock moving against the market. Are they correlated or not? And that determines the deviation. So the deviation of the market, or I should say the beta of the market, is 1. So no matter what, the market beta is 1. And so if a stock has a beta above 1, it takes on more risk than the market. If you have a stock with a beta below 1, it takes on less risk than the market. So the beta is a good number because it helps us understand risk and how one stock in particular will move against the market. And beta is a really easy thing to look up. All financial websites will include something about beta. Okay. Now, of course, once you begin to invest, once corporations are taking excess funds and investing them, they are tying them up, clearly. And so we also look at what we call the risk-free rate. And the risk-free rate in our economy, typically we use the 10-year Treasury bond as that measurement for what is the risk-free rate. Now, anytime you take any risk above the risk-free rate, we are requiring a return for that risk. And so RP is the risk premium for any particular stock. The risk that stock has above the risk-free rate is the risk premium. And of course, what the amount of that risk premium will be will depend on the stock, the nature of the stock, the nature of the industry that it's in, and so on. And so RP sub M is essentially the market risk premium, the extra return above the risk-free rate that anybody would require to invest in the overall stock market. And so the risk premium is the risk of the market minus the risk-free rate. And then the CAPM stands for the capital asset pricing model. And it's a way to define the risk premium by applying beta. So basically the risk premium for any individual stock, such as stock high, is the beta for that stock multiplied by the risk premium of the market. So we're taking the risk premium of the market and adjusting it for how risky is any one particular stock. So if stock I had a beta of 1.5, you would have a higher risk or a higher return would be demanded for that stock. Let's say stock I had a beta of 0.5, it has lower risk, therefore I'm okay with a lower return. So that number, the beta, multiplied by the risk premium on the market, helps us determine what should the risk be, or what's the return required for any individual stock. The next big topic in the chapter is derivatives and using derivatives to manage risk. I'll give you an example here of what I'll call forwards. A forward is an agreement between two parties who have opposite risks from each other. So one is trying to minimize that risk and kind of bet that risk, moving a certain direction and minimize it down the road. Commodities change in price all the time. No one company can ever control what the price of a commodity is. You just have to take the price that's there. So if you deal with commodities, if you sell them or buy them, you literally are a price taker. You have to take the price that's on the market, unless you enter into derivatives and some contracts to try to manage that price. And so an example is oil. And so a forward is a custom agreement between two parties who have opposite risks. So an oil drilling company doesn't know what the price it will be able to get for its oil 1 year from now, which will determine the investments it makes today, or the oil refiner doesn't know what price it will have to pay for crude oil 1 year from now. And so what they can do is basically enter a contract today and agree on a price a year from now. In a forward contract is irrevocable and generally not tradable also, if they use the forward as an example. Another example of a forward is the spot price for wheat. Today, 337 per metric ton. General Mills makes cereal, obviously would buy a lot of wheat, is concerned that the rising price of wheat will disrupt their financial plan for the year. A large wheat farming company is concerned that the bottom may follow the wheat price for the next year. So the wheat company is concerned that if the prices go down below the cost of producing wheat, that would be a loss for them. General Mills is concerned if it has to pay too much to buy wheat, that could lead to a loss for them. So both parties are worried about what the price may be, and so therefore they can both lock into a contract and agree on a price that both sides think makes sense for them. So what it says here, the current price of the 1 year forward contract per metric ton is 310. The companies agree to a 1,000-ton 1 year contract. Okay, so they both are betting on 310. So General Mills says, we'll buy from you, Mr. Farmer, at 310, and Mr. Farmer is very okay selling at 310 to General Mills. Now think about it from the farmer's perspective, is they know what their input costs are. A farmer should know what it costs to grow a bushel of wheat in terms of planting it, fertilizing, harvest, all that kind of stuff, all the costs that go into producing a crop. The farmer's going to have a pretty good handle on that and know what the costs are, and then therefore know what price should be earned above cost to earn a profit that makes sense. So from the farmer's perspective, if 310 is a fair profit, you'd sign off on that deal and go, yes, I'll do that. Even if it goes up in price, I want to lock in my profit for sure and get that and not face the risk of loss. So from the farmer's perspective, you might see why that would make sense. So the farmer enters into a contract, and General Mills do for 310. So let's say the price rises to 320 by the end of the year. What are the cost revenues for each of the companies, and what would it have been without the contract? So General Mills agreed to 310 per ton, so they will pay 310,000. They would have paid 320 without the contract, so they saved $10,000. The farmer receives 310, but would have received 320 without the contract. So General Mills saved 10, the farmer lost 10. Was this a good or bad decision for each party? Now, if you looked at just the dollars, you would go, great deal for General Mills, bad deal for the wheat farmer. But imagine that wheat farmer, if the wheat farmer knows that it can produce wheat for less than 310 and still make a profit, lock that profit in, and then not have to worry about losing any money, that farmer is sleeping better. So that farmer is okay with that. They locked in a price that will be okay, it'll be fair, and they're okay with that. So even though the farmer technically lost 10,000, I would dare guess most farmers are going to be okay with that situation. Now let's flip that around. So same scenario here. We're going to have the $310 1-year contract for 1,000 tons. Let's just say the price is flipped though. Let's say instead of the price being 320 a year from now, the price falls to 290. Who wins or loses now? And wins or loses is kind of a relative concept here. General Mills will now have to pay 310, but would have paid 290 without the contract, so they lose 20. And now the farmer receives 310, but would have received 290, and the farmer earns an extra $20,000. Okay, so who wins or loses is probably a matter of expectations and minimizing risk and locking in certain prices. So it's hard to say, but you can say dollars wise who would have made more money or who would have lost less money. So following along those lines of a contract, a forward contract, what is a financial option? So an option is just simply a contract that gives the holder the right but not the obligation to buy or sell an asset at some predetermined price within a specified period of time. Now it's a little bit different than the forward contract. So the example I gave you with Wheaton Oil from these previous slides right here, those all dealt with forward contracts. So that's two parties getting together and agreeing on a price and a delivery date, and the delivery will happen. Okay, so that farmer signs that forward saying, I will have 1,000 metric tons of wheat to deliver to you, General Mills, a year from now. Let's agree on the price today, and that cannot be traded. Okay, that's a forward. When we get down to the options, though, now that's a contract that can be traded, so it's not the same thing. It's the right but not the obligation to buy or sell at some price within a period of time. So the key here with the option, it's different than the forward. It does not obligate the owner to take action. It just merely gives the owner a right to buy or sell an asset at a price within a certain time range, but it doesn't have to happen. So just some terms around options. A call option is the option to buy a specified number of shares within some future period. It's very common with the stock market to have those. Same with the put option, an option to sell a specified number of shares of a security within some future period. And you can have a put option on stocks and bonds. Then the strike or exercise price is the price stated on the option contract in which the security can be bought or sold, and the expiration date is the last date the option could be exercised. So you probably heard that term, stock options, for certain execs or employees of companies. It's kind of what we're talking about here. They have the right to buy something at a specified price within a time range, but you'd only exercise the option if the pricing made sense. You know, if the price is below what the market is, you would exercise the option. So for example, if stock market value is $30, but an option allows me to buy it for $20, I would buy it because you could turn around and sell it and make a $10 profit right away. Okay, so exercise value then is the value of a call option if are exercised today, the stock price minus the strike price, and the exercise value is 0 if the stock price is less than the strike price. Okay, then it wouldn't make sense to exercise it. And so the option price is the market price of the option contract. So remember that options have value. They can be traded. So by themselves, they actually do have a market value. Time value is the option price minus the exercise value, the additional value because the option has remaining time until it actually expires. And then writing a call option, for every new option there's an investor who writes the option. Whoever writes the option creates a contract and sells it to another investor who must fulfill the option contract if exercised. For example, the writer of a call must be prepared to sell a share of stock to the investor who owns the call. Okay, so it doesn't have to be called, but if it is called, the writer of the option must have the stock or the asset on hand to deliver. So a covered option is a call option written against stock held in an investor's portfolio. A naked option means you don't have the stock right now to back it up, which means you'd have to buy it to meet the call if the call happens. An in-the-money call is a call whose strike price is less than the current price. And out of the money, a call option strike price exceeds the current stock price. So in the money means it probably will get exercised. Out of the money means the option would not get exercised. Okay, then the last big risk topic from the chapter is insurance. And clearly everybody knows a little bit about insurance. You're all drivers, I would assume. Therefore, if you're driving a vehicle, most likely you have insurance because most states say if you drive, you must have insurance. So that's typically how that works. So I would assume that you do. And of course, insurance just means you're trying to minimize the risk of some hazard from bankrupting you personally or bankrupting the business. So obviously businesses have all kinds of insurance coverages for those reasons. So basically just saying, how can we take some risk that our business has and transfer that risk for a price to somebody else, namely an insurance company. Now, not all risks can be insured away, obviously. So there are some risks that you just cannot make go away. Just the risk of being in business. If I am a car manufacturer, there's no insurance I can buy to make sure customers buy my vehicle, to make sure I'm selling vehicles that people want to buy. There's not. So obviously, we're talking mostly property, plant, and equipment liability type coverages. Okay, so some risks cannot be insured, many can. So we're thinking risk of being sued, some liability issues, some kind of a hazard, be it weather, an accident, hail, fire, earthquake, flood. Those are the kinds of things that we can insure away for a price. So the example given here is an offshore oil platform valued at $1 billion. An expert meteorologist reports indicate that a 1 in 10,000 chance exists that the platform could be destroyed by a storm over the next year. So the question then is, how can the cost of this hazard be shared? So I'll move on and kind of figure that out. So the answer is a large number of companies who share that same risk. Basically, just think of any company that owns an oil rig. They could get together and everybody could say, what if everybody chips in an equal amount into a fund, and then if one of the oil rigs is destroyed because of weather, now we have a fund to compensate for the loss. Okay, that's a possibility. Okay, so obviously if there were 10,000 different oil platforms out there, and everybody chipped in $100,000, that would equal our $1 billion. So if every member chipped in, there'd be $1 billion sitting there to replace any platform that existed. Now, let's just say we found an insurance company then. So let's just say an insurance company looks at this and says, well, for a $100,000 premium, we will insure your platform for a year. Now the question is, should they demand more than $100,000 though? If this risk is, if the true risk is 1 in 10,000, and we can say that the cost of the premium should be $100,000, the question is, should they demand more than $100,000? And the answer is yes, and for several reasons. Clearly, insurance companies have administrative costs. You have to have all kinds of structure in place in order to administer claims, administer policies, pay out claims, deal with customer service, have a home office building, all those good things. Okay, so those are pretty high. So you have to charge just to cover your administrative expenses. It's just like a grocery store selling you a gallon of milk. There should be a little bit of profit there, because that profit, that gross margin, has to cover the cost of running the store and employees and things like that. And then we have adverse selection. And adverse selection is only people who need insurance buy it, right? You need healthy people buying health insurance. You need safe drivers buying car insurance. You need healthy people buying life insurance to cover for the unhealthy people, the bad drivers, the people who live a lifestyle that may contribute to premature death, right? So we need to have a large volume of people who are safer, healthier, to cover for the unhealthy, unsafe people, essentially. Then moral hazard is the thought that the people who are riskier, who take more chances, will buy insurance, but the ones who are safer and don't may not. Okay, so that's what moral hazard is. Now, also, if you think about an oil platform, and you think about the risk that if an insurance company were to insure one, also think that the odds of 1 in 10,000 don't sound too bad. But imagine that if a storm, we're able to knock out one platform, what's keeping the same storm from actually knocking out several? Because they're all by each other. They're all in the Gulf somewhere. They're not that far from each other, so there's a very good chance that a storm could knock out more than one, which kind of leads to hurricanes and tornadoes and things like that. And so insurance companies need not only a number of properties to insure, but they have to have some diversification in what they insure. Because if you're insuring only property in Florida or California or Texas or Louisiana, where I'm thinking states in the Gulf that are more susceptible to hurricanes, or states in the West that are more susceptible to earthquakes, if you only insure in those places, you might have some problems. So you want some properties insured in the Midwest, right, where we're not going to worry about hurricanes as much. Now, tornadoes may be an issue too, but if you have that geographical diversity as an insurance company, now the insurance company's minimized its risk also. So it's accepted risk, but minimize some risks too by having that diversification. So, but just know that insurance is a way for a business to transfer risk to another business, the insurance company. Not all risks can be insured against, and there's a cost to moving any risk to an insurance company. Okay, obviously that's the premium that you pay to make that happen. So just think your own car insurance. You pay a premium, and therefore you are now moving risk to the insurance company for your driving ability. Okay, and clearly people get in accidents all the time that had nothing to do with their driving ability. But we all know that whenever you get behind the wheel and on the road, there is a chance an accident could happen. Okay, so that we just have to be thinking about that. Hopefully it all made sense. For this week, there is a quiz, there is a discussion board, and then just keep on thinking about your final project. Not too terribly far from that, about 2 weeks out now. So just kind of have that in mind too, about what to work on. And everybody's let me know what their topics should be, their company should be already, so that's good. But just know that you got to keep on working on that and have it done by the due date. Thanks.